Long-term care insurance basics. Long-term care insurance pays for services to help individuals who are unable to perform certain activities of daily living without assistance or require supervision due to cognitive impairment such as Alzheimer's disease. Feature of long-term care policies. The best policies pay for care in a nursing home, assisted living facility, or at home. Benefits are typically expressed in daily amounts. With a lifetime maximum, some policies pay half as much more per day for at home care as for nursing home care. Others pay the same amount or have a pool of benefits that can be used as needed. Criteria for the beginnings of payments. The policy should state the various conditions that must be met. They can include the inability to perform two or three specific activities of daily living without help. These include bathing, bathing, dressing, eating, toileting, and transferring or being able to move from place to place or between a bed and a chair. Cognitive impairment. Most policies cover stroke and Alzheimer's and Parkinson's disease, but other forms of mental incapacity may be excluded. Point number three, medical necessity or certification by a doctor that long-term care is necessary. Most policies have a writing period or elimination period. This is a period that begins when an individual first needs long-term care and lasts as long as the policy provides. During the waiting period, the policy will not pay benefits. The policy pays only for expenses that occur after the waiting period is over if the policyholder continues to need care. In general, the longer the waiting period, the lower the premium for the long-term care policy. Benefit for periods for long-term care may range from 2 years to a lifetime. Premiums can be kept down by electing coverage for 3 to 4 years longer than the average nursing home stay, instead of a lifetime. Most long-term care policies pay on a reimbursement or expense equal basis up to the policy limits. In other words, if the policy has a $150 per day benefits, but the policyholder spends only $130 per day for a home long-term care provider, that policy will pay only $130. The extra $20 each day will in some policies go into a pool of unused funds that can be used to extend the length of time for which the policy will pay benefits. Other policies pay on an indemnity basis. Using the same example as above, an indemnity policy would pay $150 per day as long as the insured needs and receives long term. Yeah, but inflation protection is an important feature, especially for people under the age of 65 who are buying benefits that they may not use for 20 years or more. A good inflation provision compounds benefits at 5% a year. Without inflation protection, even 3% annual inflation will over 24 years reduce the purchasing power of a $150 daily benefit to the equivalent of $75. Six other important policy provisions. Point number one, elimination period. Under some policies, if the insured has qualifying long-term care expenses on one day during a 7-day period, he or she will be credited with having satisfied 7 days toward the elimination period, the time between an injury and the receipt of payments. This type of provision reflects the way home care is often delivered, some days by professionals and some days by family members. Point number two, guaranteed renewable policies. These must be renewed by the insurance company, although premiums can go up if they are increased for an entire class of policyholder. Point number three, waiver of premium. This provision ensured that no further premiums are due to once the policyholder starts to receive benefits. Point number four, third party notification. This provision stipulates that a relative, friend, or professional advisor will be notified if the policyholder forgets to pay a premium. Point number five, non-forfeitures benefit. These benefits keep a lesser amount of insurance in force if the policyholder lets the coverage lapse. This provision is required by some states. Point number six, restoration of benefits. This provision ensures that maximum benefits are put back in place if the policyholder receives benefits for a time, then recovers and goes for a specified period, typically 6 months. Monthly receiving benefits. Disability insurance basics. Disability injuries affect millions of Americans each year. Disability insurance, which complements health insurance, helps replace lost income if an individual is unable to work due to a disability. There are three basic ways to replace income. Point number one, employer paid disability insurance. This is required in most states. Most employers provide some short term sick leaves. Many larger employers provide long term disability coverage as as well, typically with benefits of up to 60% of salary lasting for a period of up to 5 years until the age of 65, and in some cases extended for life. Point number two, social security disability benefits. This is paid to workers whose disability is expected to last at least 12 months and is so severe that no gainful employment can be expected. Point number three, individual disability income insurance policies. Other limited replacement income is available for workers under some circumstances from workers' compensation if the injury or illness is job related. Auto insurance if disability results from an auto accident, and the Department of Veterans Affairs. For most workers, even those with some employee paid cover. Veterans age and individual disability income policy is the best way to ensure adequate income in the event of disability. Workers who buy a private disability income policy can expect to replace from 50% to 70% of income. Disability benefits paid out on individual disability policies are not taxed. Benefits from employer paid policies are subject to income tax.